take your seat in the room, and I welcome everyone back in the room and online via Zoom and other channels that we have to our next session. As mentioned this morning and yesterday, this day is very much about presenting some fundamental studies about the future of the German model that we have commissioned over 1 year ago, and that we've been working on in different forms and in sessions and steering meetings and so on since. And the first one was on inequality, which is one of the main topics, main issues of modern times and challenges this morning. The second one that we will now discuss is on fiscal policy. And we have touched on that topic a lot of times during yesterday, the sessions, and today. It's mainly, I mean, we've commissioned a study last year before anyone knew that we will be in the situation that we are now with Corona, but the issue was there already to know how can we cope with the regulatory system in Germany, with the debt brake and its issues, and some issues that it implies, like maybe a problem for investment, public investment, and other issues that we will discuss in a second. So we asked Michael Hüther and Jens Südekum, two very prominent economists in Germany, to work on this and present the study today. And Michael is here, Jens is online. Michael Hüther will present this study on the debt brake and on a new paradigm for fiscal policy. That's the issue that we have in general in our discussions and at the forum, is about how can we define a new paradigm, and maybe there has been no paradigm that now is not adapted to the situation anymore, and we need a new one. Michael, please present your thoughts and your study. Thank you.
Thomas, many thanks for inviting me, or inviting us, first to produce this paper, this joint paper, and second to be here today. Ladies and gentlemen, it's really an interesting topic to focus on the story on the German debt brake, the German fiscal policy regulation, looking back for the last decade and looking forward. First of all, what's going on? What are the drivers of German fiscal policy? I would say, yes, there's a paradigm. The traditional paradigm is centered on deficit control, is on reduced state intervention. This has a background of long-standing experience since the midst of the 1970s of a rising debt ratio. We will, in a few seconds, I will focus on that. And combined with that was Karl Schiller, the German most still prominent Minister of Economic Affairs, and the father of global steering, managing the global economy, the whole economy using fiscal policy instruments, said in 1986, we also realized the misuse of Keynesian instruments, because in times where we had no Keynesian problem, we had a supply side problem, for example, and this misuse combined with this experience of the rising debt ratio was a background in the for 10 years time ago to say maybe we should have something different. A new regulation, what we call the German debt brake. And you could ask today, was this the wrong instrument for a right reason, or the right instrument for a wrong reason? Both is possible, and let's go a little bit in. So first point is just looking on the figures, a little bit what just happened after financial crisis and before Corona, and then the crisis management and our ideas of a new framework. It's still work in progress. We will finish our paper just after this conference to bring in all your arguments and ideas. So looking first on the debt ratio, debt in percent of GDP and employment rate, you see here, this is a story which started in mid-1970s. After in this period, we had this, what Karl Schiller in the retrospect called misuse of Keynesian instruments in supply side environment, an increase from 20% debt ratio to 40%, a stabilization during the 80s. The second hike was then after German unification from 40 to 60%. And then in very short period of time, in 2008, financial crisis to 2010, an increase again 20 percentage points to 80%. And then since then we were able to reduce the debt ratio to 60% again just before Corona crisis. Two different narratives you can have behind that. The group of economists saying which are in favor of the debt brake, this is only due to the debt brake. The others, the criticism position, or the critical position saying no, that has nothing to do with the debt brake. And as we all know, the truth lies in between. We had some other factors, and from my side, the most important factor is the involvement of more people into the labor market situation, the increase of the employment ratio from 69% to nearly 80%, the people in the age between 20 and 65. This was, we had never before. And my hypothesis is you cannot have a balanced budget if the labor market conditions are worse. So if you're working on labor market, if you bring more people into jobs to good compensation, then you have a chance to bring this debt ratio in line with the other regulation we have from the European side, the Maastricht criteria. And there was some help, as we all know, from the low interest rate, and in this surrounding the debt brake was some help in the budgetary procedure. If you ask politicians, members of parliament, saying that in the discussion between parliamentary groups, this debt brake had some impact, it's quite clear. But this wasn't, in the end of the day, what we have to realize is was the investment, the public investment, the loser of the last decade. And you see this here, the shrinking net capital stock in Germany, compared it with all the other. On the left side is Japan. All the other had stabilization of the net capital stock or an increase of the net capital stock. And you can use different other indicators. You will show you the same. We ask several times a year the companies, what are your outlook, your perception of the present-day economic situation, and sometimes we use to bring in some special questions, and one is here on the infrastructure deficiencies. We asked in 2013, 2018, and what you can see here in this simple chart is that the problems are more severe than 5 years ago, and it's all infrastructure networks are attached. It's road transport, it's communication network, it's energy supply, rail, air transport, and so on. So there is a widespread impact of this poor quality, would say, of the German public infrastructure, with an impact on our growth potential we will see in the medium term. Looking at that, the question is why were the people able or willing to bring the debt brake to the constitution in 2009? And I think it's very important to see that we had a very broad consensus. This was not a left-wing, right-wing story in this time. The Social Democrats were the same line as the Christian Democrats, saying this is a good idea, and the Liberals as well, to have such a debt brake in. And we should not forget, if you're looking on the economic discussion, that we also have two different narratives. There's a more conservative background under the headline avoidance of excessive state. But there's also a more progressive left-wing narrative avoiding a starving state, just after the experience of the Reagan administration in the United States, which pushed down the tax rates, something like the race to the bottom tax competition. And from this side, they say, no, we want to have a stable expenditure ratio. So from this, we have to be also aligned that there should be a stabilization of the debt as an instrument to make clear that there's no room for further reduction of tax rates. So this, you should not forget, you have two different narratives behind. And I believe we should not forget that in the late 80s, a lot of expert commissions were started in Germany focusing on lean government, lean state. The expert commission on lean state in 1989, big report on in which way we should organize and managing public activities, and the expert commission of deregulation, which published the report in 1990, focusing very different fields of activity of the state. The outcome in the end was that investment is a loser of this period, and What we also have to realize that we have a very dramatic impact on the municipalities, of the fiscal stance of the municipalities. We have a lot of structural problems for the municipalities in North Rhine-Westphalia, Rhineland-Palatinate, and Hesse and in Saarland. Well, there we do have still the structural problems, and they have a high structural deficit, and we will have to work on that. In Hesse and Saarland, they started, but we have to move on. So the second, just very short, because we just discussed a lot about the crisis reaction of the of politics in Europe, in Germany as well. First stance, it was the situation that liquidity matters. In March, we had this combined supply side and demand side shock. So in the first row, we had to focus on stabilization of liquidity in the companies. Then after opening up the lockdown, and in May we could see that there was something of bottoming out of the economic activity, and regaining productivity and regaining production puts the second policy idea or second question to the table, in which way we can use Keynesian impulse, so demand side policy, to bring back demand in line with the production potential or the potential output. And the third perspective is on the left side. Here's a future package work focusing on growth and structural change as well. But could say that we have learned a lot of lessons from the financial crisis. In the financial crisis, we used different instruments in between. Some colleagues from Kiel Economics and the Halle Institute made some research in which way, which instruments were effective or not. And we could use these resources. The child bonus, for example, was very clear that it was effective. It was also effective as a premium paid for cars, but this was a different surrounding. So I think we started a very impressive program beginning of July, and it should be terminated, and it should be temporary, as Keynesian politics targeted, timely and temporary, just in line with this year. The outcome, the effect of the fiscal stance is as outlined here. For the federal, state and the local level, additional expenditure, revenue losses. On the other hand, we will see, this is just our calculation this year, debt ratio will be around 76, but below 80%. It's also a forecast for next year. It has to do a lot with the new consensus forecast. We started with a very dramatic consensus forecast, cleared more close to 10% as a minus, and this year we just see it's minus 5%. This is had this impact that the debt ratio will not above 80%. Just know that's what we see this year. What we expect for the next year, the reduction of GDP is nearly the same than we had in the year 2009, minus 5.6. It is minus 5.7. It was in 2009. This year we are just minus minus 6, but in this range we will see. We had a strong fiscal response to the corona crisis in different countries, but we see here that, as we just discussed on the European politics side, that the Germans moved ahead, and they were very tough, and in a very short period of time they decided to do a lot. There was not really a dispute about the general idea, only a dispute about the instruments in detail. But in general, it was accepted that we have to do a lot, and that we push from the demand side again after what we did first in March and April on liquidity stabilization. So this is, I think it's interesting to see that Germany is not really an outliner in a negative sense, more looking from this policy response, it's in the positive sense. Only a few remarks, because we just had this wonderful discussion about the French and German differences for historical reasons. I would say that in my perspective, it's something like a normalization of overstretching the differences. Something of a normalization of overstretching the normative anchored positions we had in the past. So if the reality is as is this year, there is such a severe crisis, then yes, there's no escape from reality. We have to answer. And we should also not forget, since the year 2000, we are more or less in a rush hour of big crises. 2001, 2003, and so on, 2009, then 2012, you can have a row of big crises. One in itself would be a threat for our economic perspective 10 years ago or 20 years ago, but no, we have it in this only 2 decades. And I think if this is such like a rush hour of crisis we are in since the beginning of the new century, there is no other way as to have evidence-based, more than in the past, evidence-based politic answers. So a new framework of rules and procedures and strategies for fiscal policy should reflect this experience on the one hand from the last decade and over the longer perspective in historical terms, but also what we see forward. The lessons learned. First, we had a consolidation success in the last decade based on employment-intensive growth, low interest rates and limited budget discipline. For me, it's quite clear that from employment-intensive growth and low interest rates, there could be not the same impact for the next 10 years, because we have already 80% of the employment of the workforce in the labor market engaged. You cannot increase above to 90%. If you're on international standards, there's no room, can little bit. Maybe we have a struggle to have a stabilization of employment, but I do not have the idea that we will have another increase of 10 percentage points in the next. So that means it's not so easy. The situation in front of us is not so easy as it was the last decade. The debt brake was an expression of small state-lean government, and not forget the 2 different approaches in interpretation. It was based on a broad political consensus. Pandemic shock was answered quickly and was based also on the broad consensus. The black zero is obsolete. Fourth, if there's such a paradigm shift, I think it will be based on 2 key drivers. First, the obvious large gap in public investment. The crisis we do have in public investment. And second, that we have a fundamental shift in the interest rate environment, which in turn must have a bearing on the conduct of fiscal policies, the fiscal paradigm more broadly. The fact that over all maturities, the interest rate for government bonds is below, in a normal economic surrounding, below the GDP growth rate, means that we have a different situation than we had in the period when we discussed the debt brake. So this is not in a systematic way reflected in our debt brake, and it should be, as we will answer. Extremely unconventional expensive monetary policy, also in combination with what we realize on Next Generation EU, will be driver for such a paradigm shift. And this last point here, we should not forget, we do have a specific problem in Germany to fiscal federalism. We do have the high debt in some German states, as I mentioned before, on the local level, and it's not really solved up to now. It's solved to a certain degree in Hessen. It's solved to a certain degree in Saarland, but it's still waiting in the problems to be solved in North Rhine-Westphalia and Rhineland-Palatinate. And it's crucial that we cannot change the debt from one level in the federal system to another inside the debt brake, because in overall the debt ratio will not affect it, the debt amount will not affect it. So this is also not really a feasible basis. This is just, I made this chart yesterday, what we have on decision about the German lender, in which way, which year they want to start with the repayment, how long they want to repay, and in which kind every year. And you see there's a wide range. In Saxony, in 6 years, all problems are solved. In North Rhine-Westphalia, 50 years. This will have an impact on the coordination and the activity in the German Federal Republic of fiscal policy, because this is not coordinated. And the question in which way we can do it, it's very simple for the federal government. He can organize a long-term repayment and use his structural credit. He can use every year 0.35% of GDP. For the lender, there's no other way. So this is, as I said before, this is our expectation that the current yield on German government will also, we will come back to the situation if we have once solved more or less the COVID-19 pandemic. Last slide, these are the argumentation, what should be changed, what should be the content of reform of the debt brake. First, we should have a more flexible debt brake. It's not so easy to grow out. This was this more or less a strategy in the last decade. So if there is no way to grow out, what we have to do is to make clear that the impact of Corona debt should not reduce the expenditure on the one hand, and should not use as an argument to hike the tax rate on the other hand. So if we want to do this, we need the same flexibility the federal state has for the German lender, and we should organize this maybe in a coordinated discussion in the Stability Council. The second is pushing forward transformative growth. This is the idea to have a public investment fund, as it was designed by Sebastian Dulin, some colleagues of our institutes. And again, as this corporation, it's a KÖLN DÜSSELDORF corporation, you see it's a fruitful one. Was not always the case in history, but in this time it is. And we have the idea in which way we can use the changed investment surrounding R minus is lower than G, to give room for this, to have more understanding that it's very easy to start public investment in this way. The third pillar in our orientation is a Maastricht conformity, but we should have more time. And I think we should argue that should argue in favor of using the next generation EU as starting of an EU investment union. This could be a pillar for new financial architecture. On the one hand, we have the normal budget as it's designed already, and then we use this next generation EU based on Euro bonds for investment purpose, and to have such a way a new second pillar for financing Europe, as not only acting on administration, but also offers more opportunities for investment. Thank you so far.
Thank you very much, Mr. Hüther. We now have an excellent round of commentators, international commentators, and I think that's a very useful way of approaching this. We have a lot of intra-German discussions, but I think in that situation it's particularly interesting to hear voices from abroad, even if partly they are not non-German. Like Guntram. But I would like to hand over to Daniela Gabor first to have your comments on this study. You are from Bristol and a very well-known economist in fiscal policy terms and broader questions. So please.
Okay, hi everybody. Hope you can hear me well. Yes, I am unmuted. Can you hear me?
Yes.
Yes, okay. So thank you for the invitation, and it's a pleasure to comment on German issues as a non-German, truly non-German, although I'm Romanian based in Bristol. And I want to start by saying that I very much enjoyed reading the paper, and I want to congratulate the authors for exposing so clearly the historical and political trajectory of the fiscal paradigm that has dominated Germany and influenced heavily the debates in the Eurozone over the past 20 years. And I have two main takeaways from this that more or less approximate what has been presented. The first takeaway I get from the report is that it paints a very stark picture of the costs, at least in terms of public investment in Germany, of the ideological commitment to and the broad political consensus around Schwarzenegger. And quite interesting for me, it also shows that it replicates an intra-Germany Eurozone with a north periphery divide, whereby export-reliant regions have more room for investment, whereas periphery ones are forced into austerity on public investment. Second takeaway is that the report stresses very much that the paradigm shift in German fiscal thinking that the Economist announced recently has not firmly landed yet, and we should think very carefully about whether it's going to arrive. And it hasn't arrived or firmly landed for reasons that are both ideational, that is the political power of the debt break narrative, and for material reasons, because we have the rapid rise in public debt to GDP ratios with the COVID pandemic that I think will weigh very heavily in German macro debates and in Europe zone macro debates. I think the report very correctly identifies a material precondition for a changing paradigm of fiscal policy in Germany, that interest rates on German bonds remain low and public debt can be serviced out of growth, as it were, as the author just noticed. And it is here that I would encourage the authors to engage with what I think is a neglected aspect in the paper and in general in the fiscal debates in the Eurozone. That is the macro financial aspects of fiscal policy and public debt. And what do I mean by the macrofinancial aspect? Macrofinance in general takes as a starting point the observation that rapid changes in the nature and organization of the financial system have significant implications for monetary and for fiscal policy. Now, if we ask how financial structure and macroeconomic policies interact, it becomes clear that evolutionary changes in European finance need to be taken into account when discussing paradigm shifts in German or other European fiscal policies. Consider the largest money market for European banks and institutional investors in the Eurozone, the 7 trillion repo market or repurchase market. 2 out of 3 euros borrowed through repos in the Eurozone use sovereign bonds issued by Euro area members, Germany and Italy the largest, as collateral. What this means is that private credit creation, which is the bread and butter of the ECB's operations, fundamentally relies on sovereign bonds and so on fiscal policy. Higher sovereign yields make private credit more expensive. In turn, the repo market creates and can easily destroy liquidity for governments in the secondary bond market. And with this, they influence their borrowing conditions and ultimately they influence fiscal policy. So through this macrofinancial lens, I have two, I would say, small doubts about the report or where the report could elaborate further. One is a lingering view that I read in the report, and maybe the authors would counteract that it's an unfair view, the lingering view that Germany needs debt consolidation, be it because of the Maastricht criteria or because of the German macro fondness for Goethe's view of public debt. And here I would urge the authors to consider the question of debt consolidation from a macro-financial perspective. In the Euro area, financial market structure and historical decisions of the European Central Bank over sovereign debt collateral have created an exorbitant privilege for Germany. In crisis, banks and shadow banks run to German bonds because these preserve access to repo or collateralized funding. This is why the leaders of periphery, between quotation marks, Euro countries, watch the spread to German bonds nervously. And incidentally, this is why the European Systemic Risk Board and various academics who also discuss this question of the exorbitant privilege that Germany has in capital markets in the Eurozone have tried to create, through a coalition of Eurosystem central banks, a single safe asset that can take away this exorbitant privilege from Germany. And from this perspective, I really wonder whether we have the tools to identify how much public debt is too much given the financial structure of the Eurozone. So I would urge the authors to expand their safe asset discussion on page 20 by situating the German Bund safe asset story within the European finance story and the question of exorbitant privilege. I'm also wondering whether the next generation EU that has been mentioned, although it may be a Hamiltonian moment for Europe, it raises questions of the implications for the demand for German bonds and the question of low interest rates. Are the volumes that are going to be issued as common debt significant enough to displace the German bond hegemony, at least in the European repo market and in capital markets in general? What does it mean for the assumptions that interest rates on German bonds will remain low for secular reasons? And this takes me to the second question or doubt I have, and it focuses on the paradigm shift. The paper talks about the paradigm shift on fiscal policy without touching, in my view, in a sufficient depth on the relationship with the central bank. Can and should we move away from a German fiscal view without rethinking the question of coordination with central banks? We already know through a macro-financial lens that the ECB intervenes in sovereign bond markets for prudential reasons. When Madame Lagarde talked about targeting the spreads, that to me was an acknowledgement after a long time that the liquidity of sovereign collateral in the Eurozone is critical for financial stability, not only for public debt questions. So I would say that the ECB didn't intervene in sovereign bond markets because it worried about debt sustainability. It intervened because that's an effective way to support private credit creation and the transmission mechanism of monetary policy. Improvement in financing conditions for governments that are much decried in some European and German circles are not a policy target for the ECB, but they are a side effect of the repo-based sovereign debt order that the founders of the euro have put in place. And when they did that, they didn't appreciate the complex political ramifications, in particular, the structural pressures on central banks to intervene in sovereign bond markets. I think given the growing public debt to GDP ratios and the possibility on renewed pressure on vulnerable sovereigns in the next 5 to 10 years, it is imperative that we rethink this order. So for this, I think we need to update. So I wonder whether we need to update the institutional framework that governs the relationship between central banks and governments. What we've had so far is that the ECB, but also other central banks, have improvised through unconventional monetary policy measures, but on terms that they control, that the central banks control. Is this a political scenario that we are comfortable with? Or can this political scenario effectively prevent the fiscal paradigm shift that the paper welcomes? Thank you.
Thank you, Daniela. Agreement in the audience. Before coming back to the German discussants, Eric, can I ask you your take on this study? You're a very well-known economist working for M&G Investments, but also having written a book that we presented recently and discussed recently on Angrynomics that we can recommend very much, and you'll find the session that we had on our website. Maybe you touch Angrynomics, which is an excellent way of explaining our times in your take, but your comments on this study, please.
Sure. I mean, first of all, I just want to say how much I enjoyed the study, and I enjoyed, in fact, the framing of the problem or the issue that we've just seen in the slides that Michael presented. I just want to make a few general observations, and I'd be very interested to get the author's thoughts on this, because I've given an awful lot of thought, like we all have, to fiscal rules. And from experience of thinking about fiscal rules, I've come to some conclusions which I think are relevant to the context, which is, to me, there are really two tensions in any fiscal rule structure. The first one is, to what extent should fiscal policy be oriented around future liabilities versus current conditions? And we repeatedly face this dilemma, which is we can think about long-term liabilities. Typically, we focus on liabilities. We think about long-term liabilities, and then we kind of plan as a government against that backdrop. And yet the reality of fiscal outcomes is that as long as policy is operating within the realms of the normal distribution, as long as policy is reasonable, it is usually exogenous factors that are determining the actual fiscal outcomes. So we can if we look across the developed world, we can largely explain debt GDP ratios without reference to fiscal policy. So it's largely a function of what's happened cyclically, what's the behavior of the private sector, what is the interest rate structure, rather than actually the starting point or the determining factor being a fiscal objective. And I think that's easy to forget. The other challenge, I think, for fiscal policy is a tendency, and economics hasn't helped here, to view the fiscal authorities in isolation and forgetting that the fiscal authorities are part of a system. And I think this touches on a lot of the points that Daniela is raising. But of course, the fiscal authorities are not. So we can't view the state's balance sheet in isolation. We've got to think about the state's balance sheet relative to what the needs of the entire system are and the changes that are happening elsewhere in the system. Now, how do we design rules given these inherent tensions? And I think an error that's been made in economics, or I think the economics of debt sustainability is incomplete. Let me put it like that. Because what we've tended to do is we start with the objective of, we think about sustainability in terms of a stable debt to GDP ratio. Right? That is how most fiscal sustainability equations start. We back out what we should do based on having a stable debt to GDP ratio. And as the authors have very intelligently and coherently put forward here, in Germany, in a sense, we tend to go even further, which is we view fiscal success based on a declining debt GDP ratio. Now, I want to think about that because I don't think it's satisfactory. So it's clearly unsatisfactory to say I'm going to run fiscal policy unsustainably, But we could define sustainability in a way that's independent of the debt to GDP ratio. And I think, and this is where I really want to compliment the authors, but I want to hear more about this, is I have come to the conclusion that the most flexible and effective fiscal rule actually starts by looking at the cost of debt. So I've just been on my Bloomberg looking at where 30-year German government bond yields are. And the German government can now borrow at minus 11 basis points, minus 11 basis points for 30 years. Now, as you alluded to, my day job, I'm making financial investments. If I have a discount rate of minus 0.1, I can create enormous amounts of fixed for 30 years. Right? Can we not find some investments with a higher expected real return than more than minus 2% real if we believe the ECB's inflation target? Or can we not get a nominal return on capital higher than minus 0.1? Now, what's very intriguing about that is this is actually capital investment that strengthens my balance sheet. So if I think in terms of my net assets, if I borrow at minus 0.1 fixed and I make, say, a 2% real return, which if we took, for example, sustainable energy investment with regulated utility electricity prices, we can make 6% real returns in the Eurozone, right, within sustainable energy investment. That is value creating. In other words, that would be an increase in my debt ratio, but also simultaneously an increase in my net assets. So my assets would go up by more than my debt. And so this is where I really think I'm very interested to get the author's thoughts on this and Michael's reflections on this, because I think the investment fund is a great idea. And I think, in a sense, we need to think slightly more creatively to adapt to the current circumstances. And this is not about saying there's no limit, clearly, because there is a limit, but it's thinking of sustainability in a more rigorous and complete way. Because I think ultimately the interest rate, in a sense, is a system indicator. It's telling you about what other parts of the system are doing. And it is giving you an objective standard. And it's also permitting some of the functions for fiscal policy that Daniela is alluding to, which is actually that it may be that the system requires more bonds for other financial stability reasons. But I would prefer, to focus really on value creation for the state and society. And I think we have two challenges at the moment. One is we need capital investment. That's come through very clear. We have a huge environmental sustainability challenge. But we have been given manna from heaven, which is we have negative borrowing rates for 30 years.
Thank you, Eric. Excellent. I would like to ask Christian to come to the scene, the second real in-person contributor. Christian Kastrop is now State Secretary at the Ministry of Justice and Consumer Rights, I think. I don't know how the exact translation in English is. But very much more importantly, Christian has been at the Ministry of Finance in 2009. And that was the year when the debt brake has been done. And the colleagues from the Financial Times have called him the father of the debt brake. So we are extremely happy that you are here, because we're very much discussing now how to reform and how to do a better debt brake. And please give us your view on the current discussion and on the paper, especially that Michael and Jens have produced. Thank you.
Yeah, thank you, Thomas, for this very nice and friendly discussion. Yeah, I may have been a leader of a team starting 2005 with a new concept, bringing it in the coalition agreement. It's all a long story. I could talk for a whole night. Thomas knows that, and I have to concentrate on the most important things. But let me start. I'm not an apologetic. So I think policy is about what you do think, what for a current situation and a long-time development is the right thing to do. And of course, this may change. And so please do not expect that I'm just do an apologetic for the given system. I will indeed, I have quite another view. Of course, it can be done differently, but we have to look at different aspects. And My new job in a way helps me because very correct would be I'm State Secretary for Digital Society and Consumer Policy. So, and you see, and this is about people. So this is about people that they have the money to be a consumer, and they consume for the right things in a way, and this is also a polity task. So, so I'm really 3 reasons why I'm especially delighted to participate here. Because as we have seen, the COVID pandemic has hit all of us very hard. And as said, we are all consumers. So much of the recovery will depend on how consumers' welfare will be evolved in the months to come. And of course, the precondition for having, say, the firepower also as a public entity to battle against a pandemic. We did not foresee a pandemic, but we created an exception clause, which we have well taken now. And of course, it was the right reason to use the exception clause from the so-called debt brake. But the principal idea that we need a kind of a steering instrument which works into the direction of, say, fiscal sustainability in whatever way, or whatever it's enough or too weak or too strong, we can all discuss that. But let me make this point first, that there is an issue about fiscal sustainability with getting firepower for a future in an aging country, which can only depend on brain and high productivity and not on natural resources of any kind. So we are our own natural resources. Let me put it this way. So we are different from a lot of other countries in the world. So, so we had at least gone away in this fiscal sustainability direction. Again, in the right way, we have to discuss. But then, of course, as Michael has shown to you, what's very important also, that we have also concentrated now with the big packages, not just on the recovery, but we have also done something for the transformation of the economy. Let me mention digitalization as one of my new subjects, which is more important in our daily lives. And Jens and Michael already showed that the digitalization is a very important need for investment. And of course, it's not just digitalization, it's also circular economy, say, not just fiscal sustainability, but say sustainability of our whole society, which in the end is also related to our democratic values we have here in Central Europe. Let me really make it a bit broader than just economics. And I would call this sustainability too. So overall sustainability being fit for the future. And in fact, this was the political debate when we started to develop a new fiscal rule, a better fiscal rule, which is better directed to a good future for this country. And of course, it's also for the European issue. I also had the honor to be asked 1996 whether we could drive a proposal for a European Stability Pact, but I will leave this story completely out here. So, and then of course we invented fiscal rules, and as said, that's very important for me. Of course, we can discuss whether these rules under a given condition will work, say, in a more austerity mode, but I just would like to mention here, it started all with sustainability. It was not about control and pull back the state, and this is also what Michael already mentioned, it was about sustainability for the future. So I share many points of the paper. This is very, very convincing. It's true that Germany saw very unusually strong growth after the financial crisis. And indeed that the reduction of the debt ratio, of course, was induced by higher growth and not by austerity in terms of fiscal consolidation. So we work ourselves out of the problem with growth and not with austerity. And also one of the results, of course, that social spending has not decreased, which is also important to prevent, of course, social unrest, as the paper says, but it also reduces increasing inequality, which is another issue, not having neglected groups in our society as a whole. So I also certainly agree that we have seen underinvestment or negative net investment in Germany over the last 2 decades and even longer before. But let me make a little remark here already that I would also add that we have sometimes seen too little investment, but also too little consumption of the right type in our economy. Let me just mention here teachers and other important issues. So it's an important point. Whenever we talk about investment, it's not just investment. If you want to be a high productive country in the future, you need investment, yes, for sure, of different type, yes, for sure. But you also need complementary consumption expenditure. And this is what we should never forget in the debate about investment, because the history of Germany has also seen, especially in the municipalities, quite a lot of bad investment, which were very, very expensive and really were a burden for the future and did not go for more sustainability of our local, regional and state entities. So we have really to be a bit careful to overuse the term investment. And this is another point I want to make. So, should not be too long. So, of course, it is important that the German multi-tier federal fiscal structure can be tricky. So we know that also some municipalities are rather well off and some have huge problems, especially in my home country, which is North Rhine-Westphalia too. So, and this can of course spur inequality, and consequently, I think it's independent from the debt brake. Over the last 2 decades or so, we have seen rising regional inequality in terms also of high quality investment and the quality of public goods. This is true. So, and of course, there has been an issue in Germany of some, say, more conservative groups in the society. This is about a lean state or a rollback of the state. But I think it's not as dominant as we have seen it, for instance, in the US or in the UK. So, and at least in Europe, I am rather confident that most policymakers have understood how important the state is beyond just being a referee for free markets. Climate change, investment in the data economy, intangibles, inclusive growth, all this needs strong, but let me also make the point, it needs an efficient and effective state. So as we need inclusive economic and sustainable growth. So let me now come to some points I would like to add to the paper. So debt brake is sometimes indirectly linked to low public investment, but as said, low investment was also before 2009, and this may not be the entire reason. And if we look about the figures, and this is also well described in the paper, that the debt brake, of course, was, as it stands today, it was not ever a break for investment. We have to keep in mind that we were, after the crisis, we had this boom, and also is mentioned in the paper, but we have also to see what are the political priorities we have set. So I may also offer the view here, but when there was an affluent situation in the German public finance in the years after the crisis with the big boom, that the priorities, the political priorities, were set on other types of spending than, say, the pro-future oriented investment or consumption expenditures. So, for instance, we did, and I think the figures are there, state consumption, social spending. As said, social spending is also necessary, but some elements of the additional social spending, of course, was not really something which helps us for the future. So my point here is that we talk about fiscal rules, and if we talk about policy which is conducive to it, it's always about political priorities. And that's, I think, the most important point. So, and the key priorities, like the green transition, for instance, have been much less politically focused on 20 years ago as compared to today. So we must be honest about this. So also, let us not forget private investment. So it makes up 10%, public investment is only 10% of all investment. So why is private investment so low? A recent study has shown that at the same free cash flow level, firms invest much less than in the past. So firms also underinvest because they want to, not because they have to. Of course, it's about the overarching global environment and economy. So we should look at that too. So, and indeed, investment and GDP growth should not be seen as distinct entities. The right type of investment, of course, can boost GDP growth even further, and therefore, as mentioned, drives down the debt to GDP growth also. So, what about the future agenda? So of course, I also agree that R below G may require us to rethink investment policy. It may indeed be favorable, as mentioned here also from Eric, favorable to debt finance investment plus X again, from a technical point of view. So again, let me make this point very clear. This is why a golden rule would not help us at all. A golden rule which is focusing on investment. So what is really important, I think, is something which is also discussed on the European level. I was some years in Brussels chairing one of the ECOFIN working groups, Economic Policy Committee. We had a huge project about so-called future-looking quality of public finance. So what is the growth relevance of a certain expenditure? Is it investment? Is it consumption? Or is it the mix of both? And I may tell you another story. In the early 2000s, I made a proposal to the then Minister of Finance to say we need a kind of a so-called growth and future budget. So just identify terms which pay high returns on long-term sustainability, on growth and sustainability. And I can tell you, this was never pursued. And it's still an open issue. We put it now in the European regulations, but it still needs to bring more forward. And therefore, I think the whole debate we have here today about the investment rule or about too low investment should really be more holistic on what brings productivity to our societies. So we need a kind of an inclusive productive agenda where public investment, private investment, and state consumptions are joining forces for high productivity. So let me do another thing. Of course, if we think about the given debt break system, of course, it should be a kind of a breathing debt break. It's indeed stupid that our given system of the debt break in the given economic circumstances would move. And you see this in a nice chart Michael showed us. You see that the debt to GDP ratio goes down to whatever low. This is, of course, not necessary. It would be rather stupid not to do that. So I could imagine that, for instance, we have a kind of a breathing debt break. When the debt to GDP ratio is low, you get more room. You can double it or triple it. I'm rather open to that. And let me also make this last point. I would also be very favorable to a distinctive investment funds. But again, we should really think about what investment do we mean. We do mean intangibles. We do mean the right melange of investment and consumption expenditures. And not to get too long, I stop it here with some concrete proposals.
Thank you, Christian. Last panelist is Guntram Wolff from Brussels, head of the Brussels-based Bruegel Institute. Please, Guntram.
Yeah, thank you, Thomas. It's so good to be here, and it's a pleasure to also see old friends such as Christian Kastrop or Daniela or Eric. So great to be on this panel and debate. I really wanted to make 3 points, and since you almost called me a non-German, let me start by my German experience being. Having been an economist in the German Bundesbank, central bank, in the fiscal policy department at the time of the debt break. And at the time, we had a long debate within the department where my view did not prevail, which was really about the golden rule and the question of the design of the debt break. I was making the point that the golden rule, so that existed before, was not the reason why the debt to GDP ratio in Germany had been increasing up to the financial crisis. And I think Michael Hüther's and Jens Südekum's paper shows this very nicely. The increase in the debt to GDP ratios happened at times of major crisis, be that the oil price shock or be the German reunification. I mean, these were the events that drove up the debt to GDP ratio, not investment or excessive exploitation of loopholes in investments, as some people at the time were claiming. So I think we made a mistake in the debt break, definitely in terms of recognizing investments something that should be exempted from the deficit debt rule. And I think it's a mistake because, of course, we know that the benefits of investments play out over several years, while the cost is basically happening in the given budgetary year. So as a political system, when I cannot sort of stretch the costs of investments over several years, I will have an incentive to underinvest. And I think that's exactly what is happening. If you look at the investment rates, they have been miserable and very, very low in Germany ever since the debt brake was introduced. And by the way, on top of it, we've received a systematic bias in the budgetary forecasts in Germany, which up to now COVID, basically since the beginning of the debt brake, which has led to a systematic overfulfillment of the debt brake relative to what it was originally intended to do. So German fiscal policy since the introduction of the debt brake has been much tighter than even what the debt brake would have required due to systematic biases in the forecasts. Now, the counter argument, of course, and I think in all fairness, one has to discuss that, is the point. And by the way, on the Christian's point that investment should be broader investment, I entirely agree. I mean, it's not just about concrete; it's about a much broader definition of what is future oriented. But that's a different debate. But I mean, I think the counter argument that was given and continues to be given in many circles is that Eric's idea that we can borrow at minus 0.1 and find positive investment projects that have a positive return, that idea is fundamentally flawed. I have to say, Eric, the problem with that argument is really, I mean, everybody agrees with this argument in theory, but then as Christian is saying, politics is different, and a lot of borrowing is not going to be used if you loosen up the rules too much, is not going to be used in a productive way, and so the return on that borrowing will be probably even more negative than minus 0.1. So this is I think the political economy, and I have to admit, I mean, it's an argument that has always bugged me, and I always felt uncomfortable with, because ultimately what it says is we don't trust that our democracies can think about the future. And I think this is really a problem. I mean, we are having here a problem if we don't believe that in a democratic process we can use borrowed money sensibly for future-oriented investments. I think this is really, it's really an issue, and it's something I'm quite concerned about. And I think, Christian, what you just said is essentially that also at the EU level, we find it extremely difficult to agree on sort of future-oriented spending. And we've seen that also in the experience of the great financial crisis, the fiscal consolidation that happened at the expense of future-oriented spending, not at the expense of current consumption. And so this is a systematic bias that we are starting to have in our political system, which I think we need to be concerned about in our democracies. Now, that's let me add make my last point, which is really about the debt brake in the European fiscal context. And so now I'm sort of moving from being the pure German to how you called it, Thomas, the half German, or I don't know how you call it. So basically the German based in Brussels. And of course, the big debate now in Brussels that is starting is about the European fiscal rules and the extent to which the European fiscal rules need to be changed or should be changed. And I guess the starting point here is that the European fiscal rules, especially the fiscal compact, is basically based on the German debt brake. And the fiscal compact requires member states of the Eurozone, of the EU, to reduce their debt to GDP ratio basically to 60%, with a reduction per year of 1/20th of the difference between 60 and the debt level that you have currently. So I just looked at the numbers. Italy is, according to AMECO, at 159, so 160% of GDP, France 117, Spain 116, Greece 196, Germany 75. So Germany has very little adjustment need to do to come back to the 60%. So this is very easy to do. The numbers that will be required from Italy, France, Spain, and Greece will be very, very high, according to the fiscal compact. And those numbers will be very difficult to achieve. And Michael, I think you mentioned the fact that without job growth, it's very difficult to run a budgetary surplus as well. I mean, if you look at several of these countries, unemployment is very high, youth unemployment is very high, and how are they going to run these high budgetary surpluses to reduce their debt to GDP ratios? I think it's basically politically it's not going to be possible, and I don't see how it's going to happen. So I think what we are seeing here is we are seeing here a very, very big divergence between Germany, which will, I think, more or less go back to the German debt brake as of 22, I would say. 21 is still exceptional year, but as of 22, we will go back. We will adjust very quickly back to the 60% unless something extraordinary happens. But the other countries of the Eurozone that I mentioned will not be able to do this. Now, those countries are calling for a change in the debt brake. I mean, in the fiscal compact. The problem is, even if that was achievable and if they got that in the European framework, they would still face the problem, and there I come to Daniela, they would still face the problem that Germany's debt would fall, while their debt wouldn't really fall. And so we will see a divergence of the fiscal fundamentals between these parts of the Eurozone, which in itself will create tensions in the sovereign bond markets. And I agree with Daniela that Next Generation EU is a big step forward. It's a very positive step. But of course, it's not gonna eliminate the spreads. I mean, it has reduced the spreads quite a bit. But as the divergence in the fiscal positions will start to grow after 22 again, I think we will see again tensions in the bond markets. And then very quickly we have also problems in Italy related to R-G, because basically with the spread, Italian R is going to be higher than Italian G, and so then very quickly we end up with very difficult situation in other parts of the Eurozone. So I guess overall my take is I think we should have we need to have a debate in Germany about the debt brake. I think it should be a debate which is a little bit politically more optimistic, and where politically we work on making sure that the money that we borrow is used productively, but where we give the space really to invest in the future. And I mean green or all the other things. I mean, I really think we need a bit of more flexibility to borrow for future-oriented investments and make sure that the politics of this works, that we can actually still invest in the future. Thank you very much.
Thank you, Guntram. Just before handing over to Michael, because a lot of questions, we will switch from the debt break to the lunch break in 15 minutes, let's say. So we need to be very efficient. First in your reactions and maybe then another round. And if there's any question in the room, please. And
I will try to do it very brief. I'm all my hopes fulfilled that we will get such a wide range of comments and constructive ideas to bring into the paper, and so you can read all this, what we will do on that. But only a few sentences about what we have heard from Daniela, I think it's very important, your point, to bring in the interaction between public debt, bond market, and the ECB. So this is really the point, which is only just discussed very indirectly through the next generation EU, because what Guntram said, it's our idea to use this European pillar to bring to have the chance that in all the other European member states the employment ratio will move up, and then they have a broader basis for public finances, and this will help us to bring the Eurozone a situation that we will not have such an tensions as described as a risk by Guntram. The general one general idea was how much public debt is too much and what's, you can say, too low, because it may be too low if we to have an underinvestment, which will have an ongoing reduction of net capital stock, as we could see in the first chart I showed to the audience. So I think here it's very easy to say, on the one hand, we have the acceptance of the bond market. If the bond markets, say Germany is a stable country, a stable economy, so we are willing to pay in premium if you will host my money. That's what really do. Yeah, for 30 years is such a promise of the German government that if you give me the money, I will also had a premium. So you have the security, the safety. This is a really safe harbor we are in. This should be used for investment. This is, if in the case the Norwegian state used the oil and gas resources they have to invest for the future, because this is a resources we have just now, but no, maybe not for the whole future. So let's use all this resources and the revenues coming from that for investing for the future. The same idea is behind the investment fund. Use the situation on the government, on the government bond side, on the bond market, to bring more public investment on the road and to have a higher growth potential. And quite clear, it should be efficient, it should be effective. And my idea was something to say, if we can use some institutions we already have, use the stability board, saying they have to sign in. This is an investment which could be possible in the infrastructure fund, and then the Parliament will decide on that. So you can have such a procedure to have such like a screening of investment projects, which will have to go to the future. Yeah, value creation. Eric said on that, and also the bring back the macro. For me, it's something like bringing back macroeconomics to economic policy. For some long time, we discussed only on institutions. Maybe it has something to do with the situation we had, but no, if we are looking on R and G and the relation on R and G, that means that we bring in macroeconomics in a different way to the politics we used to organize. Because your points are all very interesting to see what was behind the discussion. It was for a time being in the 10 years time before the right answer, maybe. And now we have to put the question to the table, what could be the framework for the future? That does not mean that we will have no regulation, but a regulation that is more flexible, which will also reflect the problems we have on the table. As I said, the legacy debt of the municipalities, the flexibility for the lender as well, and in general, what's going on with the European side. And yes, I think, and if you're looking on the bond markets, I would say this is not only, but you mentioned the low private investment of the companies. What we see there is also structural change in digitization. The need for big amount of money has shrunk. So they can use the money they as from the future for broader investment. If you are going in the digital world, more intentional, or in this related topics for the digitalization and digital transformation of the company. And on the other hand, it's quite clear demographics. In an aging society and in the world, we have an aging process. It's quite clear that we have a surplus of capital supply. So if we have a structural change in capital market, that means for me that for the medium term, we have the outlook that R will be in general below G. And from this side, this is also to bring in the assessment on capital markets as a room for maneuver for fiscal policy. Though it's high time to debate on the debt brake. It has nothing to do from my side with ideology. It is something only to have a pragmatic answer to the situation we are just in. And so this is what we will do with our paper. And I hope Jens is also in the online audience, and maybe he will add something on that, but we will work in the next days just to bring all your comments in and to have a second edition of the paper.
To tell you, Jens is doing a field experiment on infrastructure in Germany. He's in the train and following the Zoom. So he will tell us afterwards if there's some more need for investment in it. Is there anyone from Christian or from the panelists who wants to react or have another comment on what Michael said? Please raise your hands, perhaps.
Yeah. No, I completely agree with Michael here. I think this is a very, very good approach. I think I also agree with Guntram. Of course, the so-called fiscal compact was just a stupid German idea to bully the so-called weak ones, which is anyway awful. It's also from a political point of view. This has caused a lot of damage. And I can't agree more that this was most stupid to make the fiscal compact. To be honest, when we developed the debt brake, it was only meant for a new Article 115 of our federal of the Grundgesetz. It was never meant even for the states of Germany, but nevertheless policy leads to that. So this is also a bit of a history here. Let me mention that. I think there is nevertheless one idea which I think is already in the German system with the debt brake system or with the Stability and Growth Pact, and this is the so-called preventive arm. I think the so-called corrective arm of the system, which is this 3% ceiling, this does not fit at all in the economic environment we have right now. But the preventive arm, to see what is necessary individually for each country, not one size fits all. So having fiscal sustainability, given your macroeconomic and structural performance, given your quality of public finance, given your aging ratio, given your whether you have say a very good R below G ratio or not, this all makes a difference. So we need to get a bit more, I mentioned the breathing debt brake. I think we need a bit of a breathing system, which not points that we have to reach something the next year, but we need that this goes in the right direction with expenditure clauses, with exceptional clauses, with a certain room to deviate from a medium-term path. And I think if we can do this, this would be a big political progress. But I still think this tendency to draw, say, an arrow or to shoot an arrow in the direction that we have long-term fiscal sustainability, this will also help us to create economic and ecologic and other sustainabilities we are so much in need. So yeah, the stability, I would love, I think the idea to follow a bit the Norwegian idea of a state funds, which is not fueled via oil revenues, but here we are using our gap. This is a very, very good idea. But again, we have to see how we safeguard the high quality. The stability board, unfortunately, I advised at that time the minister to make it much more stronger, give it a much better mandate. We can do that, but it needs a much stronger mandate than now as a part of an annex of the so-called Finance Stability Council, where the finance ministers of the states and the federal level are. So, but I stop here.
John, one last idea. We heard something about what is the impact of such a debt brake if you introduce it once in time for the general political sphere or the reaction of other actors. And this has something to do with the last point mentioned by Guntram. Most of the economic arguments are saying that in a democratic system, we are not able to have a future-oriented policy. And I'm very critical on that. And I would say we have to understand, if you start to introduce a debt brake, you change an incomplete contract. And the incomplete contract is the budget. The public budget is something like an incomplete contract because you offer, in general, some kind of activities and so on. If you bring some restriction in to change an incomplete contract, you will see very closely the demand for the next restriction. So the people ask for, let's say, an investment ratio. The people ask for a ceiling for the social contribution ratio. Because if you start here, you have the reaction of the economics of the political system to this restriction, and then you need a second restriction, a third restriction. In the end of the day, you will have the budgetary process no more in the parliamentary debate, but out, and it's defined more or less by the constitution. And that's not in line with the democratic system we want to have. So the budgetary process is at the core, or it's at the heart of democratic institutions and democratic decision making.
But you need a watchdog on the other hand. That's true. It's we should never do with fiscal policy what we do for some reason with monetary policy, making independent central banks here. That's not about that, say, how you see people like me, admin people rule the world or rule Germany. Never, never, ever. But they need a certain, say, how you say, nudging in the right direction. Let me put it like this.
Daniela.
Okay, can you hear me?
Yes.
Yeah. So thank you for the comments and the interventions. The discussion just now reminded me of a joke that we hear in sort of academic circles who study Germany and the Eurozone, that Germany is a reluctant hegemon, in the sense that it somehow stumbled into the position of being very powerful in the Eurozone macro-financial architecture, and it doesn't quite know what to do with it. And the comment that we just heard, that the fiscal compact was a stupid idea introduced by Germany to discipline periphery countries, makes me wonder whether Germany is really a reluctant hegemon, or there is a strategic sort of game at play. Because from what Guntram just described, what we're looking at is, for the next 10 years, the foundations of the German hegemony in macro financial issues will be strongly reinforced by the fiscal compact. So I'm wondering, for the German participants in the panel, what would it take to reverse this stupid idea? I mean, what is the responsibility that Germany has in order to reverse the kind of straitjacket that the fiscal compact is, and that is going to push again the peripheral countries into some very unpalatable political choices? And it's nice to hear in some ways that having austerity in Germany meant you only had problems with public investment, but you were able to maintain social spending at the same levels. But that's not the case for the rest of the Eurozone, particularly for periphery countries. Their social spending took very serious hits because of the austerity that has been encouraged, if not imposed, by fiscal rules coming from Germany, or fiscal ideas coming from Germany.
Maybe we have 2 minutes left. Someone from the Zoom world, Guntram maybe, is the... We can also switch to Mike.
Well, I mean, I think what I can say on this, I mean, it seems to me, I mean, my argument was it's not enough to talk about the fiscal compact. I mean, if you abolish the EU rules and you keep the German debt brake, we are bound to also have trouble. So yeah, I think what I would like to see is, I would like to see a new German debt brake, which has, you know, much more leeway on investment, because you want investment to happen now, and you know, you want not to disincentivize investment as the current debt brake is doing it. So you want more German investment, more German expenditure systematically, not just during COVID, but, you know, post-COVID. And only if we accept that, we will actually be able to sort of also loosen on the European level the fiscal compact. And then, you know, if both are relaxed, you know, then we don't run into the trouble in terms of the spreads, right? And so I think that's basically the direction of travel. Now that I think I would advocate. Now then, on top of it, you know, then you can be, you know, sort of a federalist and say, look, I mean, ideally we create a full Eurozone level on debt and expenditure and all of that. And, you know, now we have done a little step with the Next Generation EU, which is quite a big step, but it's also just a sort of, it's a temporary thing. And so it's not the creation of a permanent fiscal union. And frankly speaking, this would go well beyond this session. it's a daunting task to really think about a fiscal union and how to do it. I mean, I think it's extremely difficult in what we have. So I think what we have achieved now with this next generation EU, if it all goes through, I think is a huge step in the right direction. But it might not be enough for the next 10 years. So I think that's basically what I would argue.
Okay, Eric, very, very shortly, just.
Well, maybe just I could make a very quick question or observation, which is when we look at the R relative to G, which I'm very pleased to see has been such a central part of the discussion, I tend to think of G as in real GDP growth as less relevant than the return on capital. Now, one thing, a very interesting question that I would pose from a German perspective, if I was thinking long-term about German economic policy, I would say the R as in return on capital could easily be higher externally than it is internally. So if I have a cost of capital of minus 10 basis points, I should seek a global return on capital in excess of that. And there's two ways you can think about that, which is ironically, I encourage overseas investment spending by my state, or I could think about something like a sovereign wealth fund, which is substantially funded by debt. And I just wonder if those are ideas that are under consideration. There's a problem, which is both imply a larger current account surplus, which I personally don't have a problem with, but that is an interesting dynamic.
Excellent. I think we need to stop here. We certainly will continue this discussion as you will continue to work on the paper, and maybe we'll find another way of going a little bit deeper into the technical questions of how you would like to reform the Grundgesetz and laws. And then I would like to refer to the discussion that we will have tomorrow, which is, going directly to that, on the role of Germany in the Eurozone, which will be tomorrow morning. So we will just come back to the questions that we had at the end now. But now I will ask anyone at home and here and in the office to have some lunch. We will have some lunch here. You will have some lunch in the office. Just to say, I'm very sorry that we don't have so many longer breaks. We wanted to bring in so many things at the last workshops. There were people who said that we have a too dense program. We reacted to that and don't invite these people anymore. So please have a quick lunch, and next time we will try to have a longer again. But thanks a lot to Michael and Christian and Guntram and Daniela and Eric. Thank you.